Jesus.
S&P 500 program trade buy level 1.
It's your wake-up call, pal. Go to work.
All right, this podcast is brought to you by masterclasstrader.com, where we have the DOM Trading Bootcamp and the Advanced Spread Trading course. Use the code TRADINGWITHGB to get yourself 20% off either of those courses. Or if you check out masterclasstrader.com, you'll see a button along the top there on the menu that says specials. Check that out too, where you can get 40% off if you buy both courses. I call it the no-brainer deal. No-brainer, 40% off. All right, let's get on with it. Okay, in this podcast, I thought I'd put together a few of the Q&As that I've received by email from the last couple of weeks, just to clear up a few things. And I figure if one or a couple of people ask a question, it probably means a few more people could benefit from the answer as well. So today it's going to be a short one. I'm going to cover a couple of things. We're going to talk about margins versus options premiums. We're going to talk about a thing called margin offsets for spread trades and another approach to calculating spread ratios. So start with margins and kind of move into spread ratios. Another question I received about interest rates, and another question I received about the legality of spread trading, which is an interesting one. But anyway, the answer is interesting. Anyway, we'll get into that. So first up, what is a margin? When we talk about trading futures are a margined product, which means you don't pay for the full amount up front. You essentially pay a deposit, and that's what a margin is. So something like if we're looking at the E-mini, your contract value roughly is about $150,000, one E-mini contract. The margin for that is $12,000. These, by the way, these might change, frequently, especially this early part of 2020, where the markets are quite volatile. So margins have been higher than normal and changing more frequently. So what I say now might not be the case, tomorrow, whatever. But you get the point. So you've got a margin there of less than 10% of the contract value for the E-mini S&P. For something like, say, the one of the micro futures contracts, the Russell 2000, the margin there is about $700, which again is higher than normal, but it gives you roughly about $7,000 worth of product to play with. So buying one Russell, you get $7,000 worth of the equivalent of $7,000 worth of the 2,000 stocks that are in the indice, but pay only a deposit of $700 or $710, I think it is exactly. Now, what that is essentially it tells the exchange or your broker that you're good for the money if the market moves against you. Now, if it moves a certain amount, you're meant to top up your account if you don't have that in your account already. I mean, if you open an account with $700 and trade a $700 margin product, you're in the idiot category. You should have a bit more money than that. But the point is, if the market does move against you and it gets down to a point, the broker, the clearing member, essentially requires you to top that account up or close the position. A lot of online brokers these days have automated closing positions. So it makes sense that if you hit buy at market and go out for a sandwich and the market moves against you and you're almost about to run out of money, it closes the position. But the margin is essentially, doesn't guarantee, but it means that it tells the exchange you've got enough money there to start with. It's something, if you buy a contract and you pay whatever it is, and you're paying out $710 in margin, you get that back. That's credited back into your account when you close the position, no matter what you close it for. Okay, it's just a deposit. It's just there while you have a position on. Now, the question I received was, what's the difference between a margin and an option premium? And the argument was, and I've seen this argument before, where people say, well, hold on, options premiums can be less than futures margins, so I'm just going to trade options instead. It's like comparing an apple with a cricket bat. It's not a fair comparison because they're not the same thing. A margin is a deposit that you get back when you close the position. If you buy a contract, the value of the contract, say $1,000, you pay your margin. you make or lose, say, $100, well, that's credited or debited to your account, but then you get back that same margin as well. Okay, so when you close the position. Whereas an options premium is the price you pay to own that contract. It's a completely different kettle of fish. It has completely different factors that make up its valuation. And it's not necessarily something you get back. It's not a deposit. It's like chapter 1 on what are options. It talks about an option being an insurance policy. So they talk about calls and puts. A put option is like a insurance policy. So when you pay your insurance premium each year, you don't get that back, do you? You've paid for the insurance. It's not a deposit on owning an insurance contract. It's you pay for the right to have that insurance contract. That's what an option premium is. So margin's completely different, so don't compare them, ever. One other question was about margin offsets. So one of my students on the masterclass trader.com, the DOM Trading Bootcamp course, we've been swapping a lot of emails about trading the micro contracts as spreads. Now, in the course itself, we talk a lot about yield curve as a good spreadable market to trade. So we talk about trading the 5s, the 10s, the 5-year note, the 10-year note, and the bonds, and we talk about margins between them and all that kind of stuff. But we've been talking a little bit. I've been talking one-on-one about these micro contracts, the micro Russell, the micro S&P, the micro Nasdaq, and the micro Dow, and how to calculate a spread ratio between those, which is a fantastic way of approaching this short-term scalping approach using these kind of markets for a number of reasons we'll talk about later. In fact, I already spoke about it in the if you've listened to the podcast on the micro contracts, the previous podcast in this series. So listen to those. We talk about why it's a good idea to trade those markets. Don't worry about that for now. But calculating what they call a margin offset, you'll see it on the CME site for those contracts, or you'll see it on other sites. They talk about a margin offset. So and that's normally quoted as a percentage, but they don't explain what the heck that means. So when you see a margin offset, here's an example. I'm reading off the CME website now, a spread between the Russell and the Nasdaq. I'm talking micro contracts here, but even the E-minis would be the same. A spread between Russell and Nasdaq would be a 3-to-2 ratio. That is, if you're buying the spread, you're buying 3 Russells and selling 2 Nasdaq. Now, if you do that, you don't pay the entire margin for the 5 contracts. Because you think about it, you've got a hedged position. One is hedging the other in a way. That's the whole point of spread trading, right? So it wouldn't be fair for you to pay 5 contracts worth of margin, would it? Don't take up too much of your capital for a trade that has, in theory, a whole lot less risk than trading the outright contracts themselves. Okay, now if you bought 3 Russell and bought 3 Nasdaq, you've got 5 long contracts. Fair enough, you pay margin for 5 contracts. But if you're buying 3, selling 2, you have a spread trade on, and you've got some offset there. So you have this thing called margin offset. So what you'll see on the CME side, it'll quote a percentage. And in this example, it says 70%. Now, what that means is that's the discount you get on the total margin. All right, so let's say, as I said, the margin for the Russell is 700. The margin for the micro Nasdaq is 1,500. If you're trading a 3-to-2 ratio, that's about $5,000 in margin, and you get a 70% discount on that. So that's about $3,500. Your total margin to pay would be $1,500. That's what margin offset is. Okay. So that margin offset is based on a spread ratio as defined by the exchange. Now, that's not always the spread ratio we use when spreading. This is the next question and answer I'll get into. First up, we looked at margins, then we looked at margin versus option premium. Third, we looked at margin offsets, right? That calculates spread margins. It's worth knowing. It's just a thing. It's yet another thing we have to know. But spread ratios, now that's a different kettle of fish. That margin, the way they look at it on the exchange can often be not the right spread ratio. Okay, so they're currently saying the Russell to the Nasdaq is a 3-to-2 ratio. I disagree with that. And the reason is because volatility changes what is the correct ratio to trade. Well, not just that actually, but that's where you start from. You start with volatility. So one method we use when you're looking at interest rate markets, you look at the ratio of what they call the dollar value, or the DVO1, the dollar value of 1 basis point. We spoke about that in depth in the Treasuries podcast. Have a listen to that if you're interested in Treasury trading. The way to do it, if it's not a Treasury product, is to calculate some other form of volatility, right, and take a ratio of that volatility. If one market is half the volatility of the other, you trade twice as many to make a spread ratio, right? That's the simple logical calculation. So we do that with a measure of volatility. You can use any volatility measure you like, whether it be standard deviation, or I like to use the average true range. It moves, it is a measure of volatility, and it adjusts relatively quickly. So that will change how you calculate a spread. I go into that in a little bit more detail in the course and how to do that, but it's kind of common sense. Once you can work out your average true range, multiply it by the tick value of the contract. Right, so using an example, let me have a quick look. So the micro Russell, currently I've got an average true range of 60 points, which is at $5 a point. It's just shy of $300 per day on average. That's the range that the Russell moves. So that is a measure of volatility, $300. Now, the S&P, on the other hand, well, let's use the Nasdaq again. The Nasdaq is a couple of bucks short of $500 per day. That's the micro Nasdaq 100 contract. $2 a point multiplied by an average true range of 249, call it $500. So you've got a volatility of $300 in one and $500 in the other. To calculate your spread ratio, you find what's close to the lowest common denominator, which would be $1,500. So the Russell, you would trade 5 contracts to the Nasdaq 3. It's a 5-to-3 ratio. Now, if we go back to that example of the margin offsets, you get a margin offset for a 3-to-2 ratio, right? Not a 5-to-3 ratio. It's a little bit different. So when you're trading that spread, if you do trade it in a 5-to-3 ratio, you would get the margin offset for a 3-to-2 and then pay extra margin for the others, if that makes sense. So that is a pain in the neck that the exchanges don't keep up with volatility as quickly as they should. I think they check it on a quarterly basis, at the very least a quarterly basis, and change it with the contracts, but they can change it more often. I don't know how often it's fixed to change. I'm not too sure about that. But what does change more often is the average true range, right? It changes all the time. If you're looking at a daily chart, it changes daily. So it doesn't change drastically daily. My experience in using the ATR as a spread ratio is if you're looking at something at, say, the short end of the yield curve, the 5-year, 2-year note, that will change frequently relative to the long end, which doesn't change so much. So you need to adjust your ratios more when you're trading that short end. But it depends what market you're trading. Something volatile, like the stock market, right now, well, that's going to change more often. And so it makes sense to keep an eye on something like that. If you are starting to look at spreads, then you need to start thinking about, well, how volatile is one versus the other? And that'll tell you how to go about charting it. Right? So you'll be able to go and chart that ratio by taking your multiplier. Let's say we're doing a 5-to-3 ratio. You multiply 5 by the first market, 3 by the second, and then that calculates your ratio. Does that make sense? So, and then you can start charting that. And then what you do, you start fiddling around with those ratios too. Like, well, I'm a bit more biased, the Nasdaq versus the Russell, or I think, those small cap stocks are going to start to pick up once the economy starts picking up, which is a thing. Then you want to bias one way or the other, and that's what spread trading is, figuring out that bias. And that's what it kind of boils down to. So that kind of covers spread ratios. I've rambled on a bit too long about that. But look, if you need more info on that, just email me. I've got some more info I can email you about it too. Another question I had, a real quick one. In fact, 2 last questions real quick. One person emailed me and said, "Are interest rates too low to trade?" And I think, well, no is the short answer, but I kind of wondered why I was being asked that question. I think what it is if you go and pull up a chart right now on, say, I'll do it, pull up a chart on the 2-year note, 5-year note, 10-year note, bond, to a lesser extent that long end. But if you look at the, say, 2s, 5s, 10s, it looks like the market has fallen asleep. We had that massive rally, which, negative correlation to the stock market back in February into March, mid-March, and then everything seemed to stop. I'm looking at the 2-year note right now. It looks like it's just fallen asleep. Let me click on the 5s. Same goes for the 5s. It had that rally to mid-March and then just went, that's it, doors closed. That's if you look at a chart that includes that volatile period in February. Now, if you kind of just scroll away and scroll that out, or look at your average true range, you'll see that the markets are still moving. On the 5-year note, you've still got 630 seconds volatility a day, according to the average. It's still low, but it's still tradable. On the note, you've still got about half of a whole point average range per day. If it's a $500 range per day, that's still very tradable. Very tradable. So the answer to the question, are interest rates too low to trade? No is the answer. There's no real reason for them to go up right now massively, and it feels like that's going to be in place for a long time. And in fact, even before 2020 came around, people were talking about interest rates staying low for a long time. They've got even lower since, but they've been talking about that for quite a while. There's no real driver of inflation for a while, but that means that there's still, that doesn't mean that there's not trading opportunity left. I mean, as I just said, the 10-year note still has a $500 range a day, and there are lots of traders out there, and I'm talking the professional end of the market too, that make their money from these range trading markets. It's a matter of getting in there, being active, and being, all of that, but that's another thing altogether. But there are people that don't necessarily need a big long trend to make money. In fact, some people don't even trade when those things are happening, and they prefer those range trading markets. So things like a $500 a day is definitely tradable. Okay, final question, quick one. I received an email last night because I talk a lot about spread trading and have a spread trading course and all of that. The question was, is spread trading illegal in the US? The answer is no. No, it's not. The question, I scratched my head for a second. I thought, what are they talking about? But what I realized is the person was mixing up the idea of spread betting versus spread trading. Let me tell you, they're completely different things. Completely different. So it shares one word, but it doesn't share anything else. Spread betting is a UK-based term. In Australia, we call them CFDs, but spread betting over there, it's a derivative product. It's essentially being able to trade on a stock or an index or whatever. It's an OTC market. It's an over-the-counter market, not an exchange-traded product. The concept of spread betting, which I think is an unfortunate term, because it sounds like it's in the gambling, 100% in the gambling kind of category, which it is and it isn't. It depends how you go about it, of course. But the concept of spread betting is nothing to do with spread trading. So spread betting means you're betting, you're trading a product that is based on the value of another, which is what a derivative is. But it's a category of derivatives, if you like, that has their own regulations and participants and all that kind of stuff. UK term. In Australia, we call them CFDs, contracts for difference. They're not illegal to trade. But spread trading is completely different. When we talk about spread trading, we're talking about trading one asset versus another. We're trading a 10-year note versus a 30-year bond or a long bond. And we're trading the price differential between them. We're trading soybeans versus corn, gold versus silver. We're trading the Russell versus the Nasdaq. We're not trading direction as such. We're just trading the value between them. Anyone who's ever traded options or read a book about options or got past chapter 3 of about a book on options knows what I'm talking about. We talk about spread trading. We talk about the relative value. Okay, so that's what spread trading is, and it definitely isn't illegal. Okay, so that's about it. We wrapped it up. That's a few questions we've covered this week. Join us next week. I don't know what we're going to be talking about then, but I'll think of something. Talk to you then. Bye now.
You've reached the end of another episode of the Trading with GB podcast. Thanks for listening and see you at the next episode.